Confused about depreciation? Let's get into it. I'm sure you've heard this word depreciation often. Sometimes people are confused on what it's about, how to benefit from it on your taxes, the whole concept. Well, I want to get into it and kind of explain what depreciation is, how it works, and how you can use it in your favor, and when it's a good time to use a bonus depreciation option and when to forego it. Because there are scenarios where it may not be the best idea to use it in a specific tax year. What depreciation is essentially this. The IRS does not allow you to fully deduct certain purchases for your business if they meet a certain monetary and useful life threshold. What does that mean? Aside from safe harbor regulations of $2,500, which you may have heard about, if you have a substantial purchase in your business, such as a piece of machinery or even a building, you're going to not just take that deduction in the year that you acquire it for the full cost, you're going to depreciate it or deduct it ratably over a certain amount of years. Let's take real estate, for example. Real estate is deducted over either 27 and a half years for residential real estate or 39 years for commercial real estate. When you're dealing with real estate, you also have to remember that there's a land component to it. Sometimes I see tax returns come in that are fully depreciating the asset and not carving out land, which is never depreciable. Or in the case of office machinery or equipment, we can be looking at anywhere from 5 to 7 years of depreciation. That means that that asset is going to be depreciated or deducted ratably over 5 or 7 years against your income. Now for 5 or 7 year property, this is where you're allowed a bonus depreciation, if you will, which allows to deduct a certain percentage of that asset in the year you place it in service. For 2024, for example, we're looking at currently pending potential new tax law changes, 60% bonus depreciation on that asset. For example, you buy a piece of equipment for your office at $100,000, you would be allowed to deduct through the bonus depreciation option $60,000 of that asset, and then you're going to deduct $40,000 of that asset ratably over the next 5 years, depending on whether it's straight line or makers. Most of the time it's makers, and we're not really going to go into that, but that's really a declining deduction option over the course of time, meaning you're going to get most of the deduction at the earlier years and then it ratably decreases as time goes on. You may be thinking, well, why can't I use bonus depreciation for that building that I just purchased? Well, simply enough, the tax law doesn't allow for it. It only allows certain categories to be eligible for bonus depreciation. Another way of deducting assets in the year that you purchase them in whole is through Section 179. Section 179 is similar to the bonus depreciation option when it comes to the fraction of the asset that you're placing in service, meaning there's no 60% limitation, again, pending any tax law changes. Now, it's also a different section of the code. This allows you to deduct up to currently $1 million of assets that you place in service in the current year, again, excluding any real estate, and is also treated in a particular way if you have losses. Whereas bonus depreciation allows you to take the deduction and find yourself in a net loss, if you utilize Section 179 against your income, any losses that you may recognize as a result will be suspended until years that you have income to recognize those losses. Any depreciation deduction that you take on your income tax return is going to offset your income proportionately to the deduction that's allowed. So going back to that 5-year piece of equipment that you purchased, during that year, you're going to deduct $60,000 against your income, and whatever else that $40,000 depreciation is on that 5-year property, depending when you placed it in service on your income tax return. So you put that 5-year property in service, that $40,000 remaining after the excess of $60,000. Let's say you get 10% additional depreciation deduction that year. You're going to be able to deduct $64,000 against your income that year through bonus depreciation. That's fantastic. You're saving money. In addition to that, you don't have to actually own that asset outright. This comes into play when you're financing a piece of equipment. You take out the loan, you get the benefit of that deduction in the year that you purchase it. There's certain instances where you may not want to take advantage of that bonus depreciation. Why would you not want to take advantage of that bonus depreciation? We just established that it's a direct deduction against your income. Yes, but what if you're in a net loss? If you're in a net loss and you're operating through a certain entity, again, it depends on what type of entity you're operating under. If you're operating under a C corporation, for example, that may not benefit you right away. because of the net operating loss rules. The net operating loss rules limit net operating loss carryover deduction for future years. You may not want to take it in the year that you're going to recognize that huge operating loss. Same example with the $64,000 deduction. Say your net income is only $20,000 for the year. If you take that $64,000 deduction, you're going to have $44,000 of a net operating loss that you're going to carry over to the next year. Now the net operating loss rules only allow you to take advantage of 80% of whatever loss you had in the prior year. Again, if you gauge that next year's income is going to be significantly higher, you may want to take that loss in the prior year. But if it's not that significant, you're better off just placing it in service and opting out of any kind of bonus depreciation and taking it ratably over the next 5 years. That way, if your net income next year is again $20,000, you're going to be able to wipe off that income with whatever depreciation result is going to be in year 2. Again, assuming it's straight line, you get a $20,000 deduction per year for a 5-year property that costs $100,000. So next year, you can just take the regular depreciation deduction, $20,000 against what you currently have, and call it a day. Had you taken bonus and you utilized that net operating loss, you would have only been able to deduct 80% of $20,000 of your net income, which is $18,000, leaving $2,000 of taxable income for you. Again, there's some analysis that comes into play when you're dealing with depreciation and placing things in service. Also, taking advantage of timing differences is very beneficial. It's part of our end-of-year tax planning strategies. If you're looking to buy a piece of equipment, you have pretty large income, you're looking to buy it anyway, and we're sitting in November or December, make that purchase right away. Don't wait till the subsequent year to make that purchase. This way, when you purchase the asset, you can take that deduction against your income and pay less tax. Again, there's an inherent time value of money principle. You don't want to lose any money. You don't want to leave it on the table. You'd rather take that tax deduction today, pay less taxes today, and keep more money in your pocket. I hope that brought some clarity to you with the topic of depreciation. One thing that you should know, some states do not conform to bonus depreciation principles. So you have to see whether your state allows for it, and if not, if it's decoupled, you have to calculate depreciation on the state level differently, and you're gonna have to keep track of it separately as well. And one common thing before we wrap up here is the sale of an asset that you've already recognized depreciation will trigger a depreciation add back. What does that mean? Let's say you buy that piece of equipment, that 5-year equipment that we just spoke about, you paid $100,000 for it, you took a $64,000 depreciation deduction in year 1, and then in year 2 you decide, you know what, I don't really need this, I don't know why I bought it, let me sell it off. You go ahead and sell off that asset, your basis in that asset in year 2 is going to be $100,000 less $64,000. Let's assume you're selling it off in January. $100,000 less $64,000, yielding $36,000 as a cost basis. Let's say you're going to sell it for 50 grand at a huge discount. In your mind, you're thinking, okay, I bought it for 100. I'm selling it at a loss of 50,000. I'm going to recognize a loss of $50,000, right? Well, that's not exactly correct, because we have to look at your basis in this asset. So what you're going to do is basically add back that depreciation to that asset. You're not going to recognize a loss on the sale. You're actually going to recognize a gain, because your new basis in this asset is $100,000 less 64, which is the depreciation from last year, and we're looking at a net basis of $36,000. So when you look at it that way, you can basically say your gain on the sale is $50,000 less $36,000. And that is what you're going to recognize gain in this case for the year that you sold that asset. So we're looking at a taxable income or capital gain in the amount of $14,000. And that's really based on a net basis. The way it really computes is there's a depreciation add back where you have to add back that depreciation, so you're paying tax on the $64,000 that you've already taken advantage of as a deduction in prior year. At the same time, what you're doing is offsetting it with the loss of $50,000, which is basically going to give you that same number. So $64,000 of the depreciation add back less $50,000 of that loss, which is going to give you a $14,000 gain recognition at the end of the day. Be aware of that as well. I know it's a little bit tricky. Feel free to rewind and watch that video again to follow through. And if you have any additional questions, feel free to comment below. I'd love to address it on another video. Thanks so much for watching. Hope you found that video helpful. Smash that like button, share, and follow my channel to be notified when I put out new content.